So in this video, I want to share something very special with you. Okay, this is going to be part of the banking series. And I'm going to be sharing with you a document that I had prepared along with my finance director, who used to be a senior partner in one of the largest accounting firms in the world. I mean, this guy has done several IPOs. He has worked on several multi-billion-dollar IPOs. He had done around 7 IPOs, which means taking a company public, and one of the IPOs was more than $1 billion. Okay, and he's a very sophisticated guy, finance expert, and he shared with me when we were raising around $10 million, when we were talking with the banks and we were looking at deals, and he and I, we developed this document together, and this is something known as a loan amortization table. It's a boring name, but in other words, how the loan is going to be paid to the bank. And I was very apprehensive about raising capital because I didn't know how this money is going to be paid, where is the money going to come from, etc., etc. So, but once I saw this table in front of my eyes and I saw every year how the payments are being made with the cash flows of the business, I saw it clearly that debt or loan is just an expense of a company. Just like you pay for electricity, just like you pay for utilities, this is just an expense and nothing more. And as long as you make sure that the cash flow covers the debt service, which is the loan payment that you have to pay every year from the business, not adding your own salary to it, your personal income aside, the business that you're buying that's producing cash flow, that cash flow itself pays for the debt service. And even after paying for the debt service, you should have extra cash remaining. If you're getting confused, once we cut to that table, and I'm going to explain on the table, everything would become very clear. But this document absolutely blew my mind because and changed my relationship to raising capital. Because when I was doing presentations with the banks, I wasn't as powerful because I didn't know how much money they're going to be making and how I'm going to be paying the loan back, or how the company that I'm buying is going to be able to pay the loan back. Not only that, but how do you decide what is the purchase price that you are going to be giving for this business? How do you calculate the purchase price? So when you go out to buy a company, you would be required to give a purchase price. How much are you willing to offer to the company? Well, how do you calculate that? Is that number that you come up in your head, or is it something that you actually use a mechanism to calculate? So this table or this Excel sheet actually allows you to calculate what price you can offer. And looking at the sheet, and we will get to that sheet in this video, but you will know, looking at the sheet, what's the top that you can offer and what's the least that the seller will accept. And you have to, what's the least that you can offer and what's the most that you can offer. And you could negotiate within that range. And if the seller doesn't accept within this range, you can actually not get the deal financed. And so there is not a deal at that point. It's just, there is no meeting point. But when you do calculate it, before you even talk to the seller, if you have the sheet, and if you just look at how the numbers would look like over the next 5 to 7 years, you know exactly what price you can offer to the seller. And more importantly, how you can structure the deal. And this is a presentation that you use with your board members. This is a presentation that you use with the banks to show them how the money is going to be repaid, because ultimately that's what they're interested in. They are interested in getting their money back. So it's important to show them how that's going to be repaid so that the bankers can see it from their point of view how you plan on paying this money back. And then you have to provide some supporting documents like audited financials, tax returns, some operations manual that, how the business is run, how many employees, etc. And also the deal sheet that you would have structured with the seller, what are the terms of the deal, so that they understand what the risks are and how that cash flow is going to be affected over the next 5 years, that is going to be used to pay off their debt. So they're going to analyze on many, many layers before they give you financing, and you should be analyzing as well because your name is on the line. And not only that, the names of your business partners, your board members are also on the line. So you have to evaluate and analyze those things. It's a very intricate process. And this is just one level of analysis. There are many others attached to it that affect the cash flow. But in very simple terms, I wanted to make this video. Once again, this is a highly regulated space. You need a financial expert, you need an accounting expert, you need a legal expert, and you need an operational expert to actually get to this point where you put these numbers on the sheet. Because if you make mistakes, you may think you're doing it right because it's so simple. It looks simple, but actually it's very complex. But I wanted to show you the final result. Before you go to the bank, you will have the sheet where you will see how the cash flow of the business pays the debt with interest. So I wanted to share that with you in this video, and we're going to now cut to that segment of the presentation. Okay, so we are here at the loan amortization table. Let me just remove these controls. So, okay, before you get confused and get overwhelmed, I just want to explain a few things here. If you understand these things, you will know what's happening and you will not be confused. So I would advise to ignore most of the sheet and only direct attention to where I am leading you so that you can see the full picture, because most of the sheet is like ground level detail, and what we want is a high level picture. So I'm going to guide you through the high level picture and you will understand the deal example very clearly and how the loan is going to be paid. Okay, so let's look at the revenue. All right. So this is just a hypothetical case scenario. These numbers are very similar to what I have come across in the field. So we have taken some assumptions here and we are taking some actual assumptions and then some projections. So you've got the revenue and you've got the net cash flow, which is what will be used to calculate the value of the business, what is the purchase price that you're going to be paying, and how the loan is going to be repaid. Because ultimately, this thing right here, the net cash flow, is what will cover the debt service. Okay, so cash flow has to cover the debt service. So this is one value. And then you've got the revenue, which is a little bit less important in this conversation, but it is important nonetheless. So you've got 13 million in revenue and you've got 4 million in cash flow, which is basically profit. And you have, this is 2019. So every year, 2020, 2021, 22, 23, 24, the business is growing a little bit. So these are projections. Okay. And we have assumed an inflation rate of 3%. What is inflation rate? Well, the Federal Reserve is printing money. So if they're printing money and there is more supply of money in the market, the business should grow at least a 3%. So 3% growth every year is not unreasonable. We are taking a very conservative scenario that our business is going to grow every year by 3%. That's both revenue and the profit. Okay. And so that's what the 3% is here. The interest rate is 10%. So we are taking a very high interest rate. It's not 10%. You could raise money at a very low interest rate, but let's assume a higher rate of interest because again, we want to be a little bit conservative. Number of years, 5 years. So we want to pay this loan in 5 years time. And number of months is 60. Just ignore the month part because that is what will make it confusing. So let's stick to years so that you have a high level picture. And this is year by year cash flow. Every year it's growing 3%. You can see first year 4 million, then 4.150, 4.2, 4.4, 4.5, and so on. So let's calculate the purchase price, okay? So the purchase price of the business is going to be calculated based on the profit. 4 million is our profit. So the purchase price, if we multiply the profit by 4, is going to be 16 million. And this is what the total purchase price of this business is. This is our offer. When the seller asks, what's your offer? We say 16 million. This is in this particular business case. You don't say 16 million for all the businesses. This is only for this business case. You say, because the profit is 4, you can multiply it by 4 and you have got 16 million. Okay? So that's the purchase price. That's for the 100%. That's the value of the whole business. And how is the purchase price going to be paid? That's a secondary issue because the whole value of the business is 16 million. The seller asks you, what's the value of the business? You say it's 16 million. Okay, how much are you paying me? Well, we're going to pay you 60%, my friend. Okay, we can pay you 60% upfront, which is 10 million, and the remaining 40%, we are going to pay you after 3 years, 4 years, or 5 years. So the seller will say, okay, when exactly are you going to pay me? And we will say, once the banks are paid off, we will pay you after that. So this is the amount, 10 million, the initial payment, what we will raise from the bank. And once we have paid this off, you can typically get another loan because you have successfully paid the loan back. The bank will be happy to give you a little more. And then you can raise this 6 million. That's one way to pay off the 6 million. Another way is that the seller can use this payment that you owe them, or you owe the seller, and they can purchase shares in your company with this 6 million. They can just convert this loan. This 6 million is basically seller's loan. Seller is holding back 6 million and he will have 40% equity in the company. I'm getting a little bit technical here, I know that, but just understand 16 million is the total valuation, 10 million is the initial payment, and you will pay 6 million after 3 years or 5 years once the banks are being paid. So what you really have to worry about is this 10 million. That's what you got to worry about. Okay, so let's look at the payment for this 10 million and we have it structured. So here is, if we add this 10 million here, the whole sheet gets created. Okay, the whole sheet gets created. So total principal, forget this each month. Okay. So you've got total principal is 10 million and you've got interest is 1 million. Okay, that's the interest. And let's look at this whole sheet. So year 1, based on this 10 million, every year the payment is going to be 2.9 million. Okay, this is our payment. Total payment plus interest is 2.9 million. Okay, and this green is our cash flow, 4.274. Okay, so let's verify. You can look at this 4.274 and here 4.274500, right? It's 2021. This is an old presentation, so again, don't pay so much attention to the year, but from the year the financing begins, this is going to be the cash flow, 4.2. Okay. And here you got 4.2 million. And our debt is 2.9. So you can clearly see here, that the cash flow exceeds the debt service plus the interest, a high interest of 10%. So this is the magic number. As long as the business produces 4.2 million dirhams or dollars, whichever currency, and your loan, your debt and interest payment is in control, I mean, it's going to be the same, but your cash flows are 4.2, you can easily pay the debt. Now, the key here is that the business should produce this much. And why are you saying it with such confidence is because the business has been producing since the last 10 years this amount. Now, obviously, you're buying the future of the business. Just because it has been producing money since last 10 years doesn't mean it's going to produce the same amount in the next 5 years. So how are you going to make sure that this stays? Well, you have to retain the owner. If you retain the owner and the rest of the business as it is, and the owner continues with the business as long as possible, things should stay intact because you have all the variables as it were 10 years ago and over 10 years. And now in the future 5 years, if everything is fine with the economy and healthcare is a stable sector and business is going well, there are no major disruptions, and you have the owner with you, you should be able to produce this. Okay, so you've got 4.2 million covering 2.9. Now you will notice every year the payment gets reduced slightly because your loan is being paid off. Here you've got 2.7 million and covered by, and your cash flow is increasing, by the way. So you've got 4.4 million dirhams covering 2.7. Okay, so it's almost double. So even after paying off the loan, you will have some cash left. Here 4.5, this is year 3. 4.5 covers 2.5. 4.6 covers 2.3. And 4.8 covers 2.1. So this is your cash flow. This is the payment, debt and interest payment. And here is the consolidated, year by year. You got year 1, total principal and interest is 2.9. This is what we have to pay the bank. Okay. And the cash flow first year is 4.2. And what you have, the balance, the cash left is 1.36, whatever this number is. Okay. So the important thing to understand is that this is a projection. It's a conservative projection, but it's still a projection. We don't have these numbers. The business has a past. And we are projecting a future based on the past, like a fortune teller. And we are taking very conservative assumptions to project the future. But we have to understand we are projecting a future based on facts, based on what has already been produced by the same team, by the same owner, by the same business, by the same services, by the same customers. Everything is the same, by the same region. We have produced income in the past, and we can use that as a basis to predict the future. So this is the future, and we are taking very conservative assumptions to project that future. And we have to make sure that how we structure the deal, we retain the owner, we retain everybody in the business, and there are no disruptions, and they continue to make money. If you structure the deal right, if you take the advice of your board members, if you perform risk analysis, if you protect those risks, you can say that, okay, we should be able to produce this 4.2. And as long as the cash flow covers the debt service here, you're in good hands and you still have this cash. Now, here is the thing. This cash is not something that you can actually withdraw from the business. Okay, most likely the bank is going to ask you to freeze this amount. You will have to freeze this amount as a security because the bank wants a little bit of a cushion. And every year, you see there is a balance every year. Once the debt is being paid off by cash flow, you will still have some money left. The bank will want you to freeze this amount. So you've got you are accumulating cash that you cannot withdraw, but it stays in the bank account. So first year, you've got 1.3 million in cash saved. Second year, 1.6. Third year, 2. And every year, this adds up. So you can actually pay off this loan early. If things go really well and if the business performs, this loan could be paid off in 3.5 to 4 years' time. So if that is the case, because you could just pay it off early, right? Based on these numbers, you can pay it off early. And I'll show you how. So if you look at this, total cash flow is 22 million and the debt payment is 12.5. So you have a very healthy coverage if you analyze it over 5 years. Again, this is a projection. This is not actual. We are projecting a future. So 22 million, assuming we produce this cash flow, can easily pay 12 million. So you have a very healthy coverage, and that's the basis on which we get financing. And this is principal plus interest, assuming a 10% interest. Okay. So that's basically the sheet. And you see this deferred payment of 6 million. If you are able to pay off the loan, let's say, look at this cash flow, 4.2 million. And this is our initial payment, 10 million. You could pay this in 2.5 years. Actually, you could pay this in 2.5 years. If things go well, you could pay it in 2.5 years. And once you have paid, so you can structure this payment, 6 million, at a 4-year horizon. So this needs to be paid at 4-year threshold or 3 years threshold. 3 year is a little too close. 4-year or 5-year threshold. And you have to convince the seller to be able to do it. If the seller doesn't accept it, you can have some conditions. Okay, we will pay you this early if the business is performing well. Why? Because if the business is performing well, it would have paid this off. And if it would have paid this off, then you can go to the bank and ask for another 6 million. Okay. So that's basically an example of a business case with a revenue, with a cash flow, with a sample purchase price, sample interest rate, and a 5-year term. Now, here is the magic thing. Sometimes this number of year, you could get it for 6 years. You could get a 6-year term of financing. You could get a 7-year term financing. And then the payments are more comfortable, even more comfortable. And then you've got, sometimes you have real estate in the deal. I heard about a deal where the guy had structured the business over 20-year payment because it's a hard asset and hard assets can be financed over long periods of time. So if you're financing something over 20 years or 10 years and you have a healthy cash flow like this one, it's at least a 40%, 30-40% margin here. I mean, and you have a long period over which you have to pay, the business is in a very comfortable position. Okay, so that is the presentation, and I'll show you something really fun here, is that you can play with this number. If you make it 12, the whole sheet changes. You see that? If you pay 12 million, now the payment is very tight. Let's make it 13 million. Ooh, this is very close. This is very, very close. So you cannot pay 13 million. It's too close. even a little bit hiccup happens in the business, you are at a risk of default. So you want to make sure that this ratio is very comfortable. Let's see, let's increase it a little more. Oh, now it's super close. Look, the bank is not going to give you money based on this. This is too close. So you cannot pay 14 million. If the seller asks you for 14 million for this business, you cannot do it. Why? Because you made this calculation, right? So if the seller tells you, I want 14 million for my business upfront, and you say the banks won't finance it. I'm sorry, the banks won't finance it. You are out of your mind. Nobody's going to finance it. And if somebody is offering this to you, please go ahead with them, because this deal cannot be financed with a bank. So they say, how much can you pay me? Can you pay me 12? No, this is too close. We cannot pay you 12. We can pay you 10. We can do a deal at 10. Okay. And you can actually change this interest rate also. Let me remove this 10%. Here is the interest rate. You can make it 6%. You see what happened? It's all of a sudden 6%. And everything changed in the deal. So this is like an automated, I don't know why this number is not changing. I'll have to fix this. But you want that this sheet changes everything, keeps changing everything. Okay. If you do change principal, yeah. Let me do 10%. Yeah, this is changing. I got to fix this. It has to still factor in the interest rate. Let me see. 10 million plus 10%. 10 million. This should be much less actually. But anyway, I'll fix this. So this is basically how the whole sheet looks like. You've got a interest and principal, and then you've got the cash flow. Okay. I'm sorry, there's some error with this sheet. I got to get this fixed. But typically the interest rate, there's a mistake in the interest rate. The principal, it's factoring, but not the interest rate. So this also has to reflect here properly. Yeah. And that is today's video, and this is the sheet, and this is how a deal looks like.